Ironically, Google, whom we all piss on, has executed the best of the four. They have a model that works. Apple doesn't even have a product that works. Microsoft bought someone else's product but doesn't quite own it, so it's kind of weird. Facebook is desperately trying to buy product, but it's not like out of success. It's out of terrible psychological need for a product, even though they don't have a business to justify it. I don't think these guys are too powerful. If anything, I think they're a bunch of rich people on the back foot behind the new trend, desperately trying to catch up.
Ready to go? Team, I'm so excited for this. We have a great schedule for today. As you know, it's always my favorite conversation of the week. So I want to dive right in and start in the world of venture. We had Victor leaving Benchmark. Now there's only 3 partners remaining, with obviously Eric, with Chathan, and with Peter Fenton. It's big news in venture. I'd love to understand how you thought about this and how you responded to it.
One, listen, if the best AI researchers are jumping from Meta to Anthropic to whatever in 6 months, or getting massive packages, there's no stability, and it should be the same in venture, right? That's thought number one. Like, this is not the bucolic, whether it was ever bucolic, but the idea of Benchmark in the eBay days of a bunch of gentlemen investors staying together for 80 years, it's possible that's part of the past, right? And then the other tactical thing, I learned this myself, if you are going to leave a fund, and you have a hot hand, better to do it early. Like, staying longer doesn't help. Like, it might seem like it helps the fund. It doesn't help you. You're probably not going to leave with much carry, right? You're going to have to start over. So there's definitely reasons to stay at a fund, right? Especially a top fund. But you might as well leave the moment you can, because, there's not a lot of economic incentive, all things being equal to stay, right? I mean, starting over is not that fun.
Agreed. And yeah, no, I think it is very interesting. I mean, I think stepping back, I remember Benchmark founding in 95. I remember them pitching us in 95. So I would have said what's happened here, and Benchmark will be fine. So let's start with that. They'll find 2 other people to fill those slots, and they'll be fine because they've been fine for 30 years. I think the interesting thing is, to a rounding error, I would have said being a partner at Benchmark is kind of one of the top gigs in venture. They've been able to hire people from other places, other good firms, get them to join Benchmark. We all know the shtick: equal carry, focused fund, no layers of hierarchy. It's a really compelling story, and it's been a compelling story for 30 years. The stunning fact now is someone can be in the best gig in venture and decide, no, it's not enough. I need something more. And they can actually probably pull that off. I mean, that to me is the big data point. It's less about Benchmark. It's like a talented individual with obviously prior entrepreneurial success can be in venture 2 years and decide to leave Benchmark, not to go back to being a kind of a founding startup entrepreneur, but to say, I can get money and continue this business on my own on equally or more attractive terms. It just speaks to where the market is, rightly or wrongly, and we can talk about that in a second, for that kind of top tier talent. It's very much a sign of the times, right? And you made a comment. Most people who are good investors would prefer to just do it themselves. You stick together with your partners for a combination of, because, you hope there's some strength and diversity of some diversification, to use a less loaded term. And because there was a perception for a long time of a bare minimum fund size, team size to get funded. And clearly all those perceptions are gone for at least a small number of very successful, talented people. And that's what we're talking about.
The nuance I've thought about over the years is, if it were me, if I were myself at that time at a similar spot, I wouldn't leave Benchmark. Because I think what a lot of these folks going out on their own miss, and Harry and I did it, right? And Harry and I had brands behind us. We actually had brands, quirky brands, Sastra and 20 VC. But I think especially today, we underestimate how powerful it is to meet a founder and say you're from Benchmark. It's friggin' powerful. And I think I would argue, Harry, I want to get your thoughts. I would argue that you and I are at the edge. Anything less than a brand that we have, I wouldn't do. I just wouldn't. Everyone's different. But it's not that you don't have the skills of hunting. It's not that you don't have the skills of evaluating or relationship building or schmoozing. But there's a lot of the best founders, they just want the same guys that are in Figma. the same funds that are in Figma. They do, right? And 20 VCs above the line, but it doesn't have the storied history of Benchmark. What do you think, Harry? That's why I'm not sure I would leave Benchmark.
I think people greatly over-exaggerate the impact that this has on Benchmark, and I don't mean that rudely to Victor, but I don't think any firm has played AI in the last 18 months as well as Benchmark have done, despite the team churn that they've had. Let's just go through this. McCaw over 100 million in ARR, HeyGen hitting 100 million in ARR, Fireworks 140 million in ARR, Sierra with Brett Taylor over 100 million in ARR, Manus AI, the best Chinese AI team there is, Legora, the best European AI team there is in many respects, all with double digits ownership in one single fund. Hell, how do I be an LP in that fund?
I'm going to call stop here, only because you actually didn't answer the question. We agree. I mean, let's stipulate Benchmark will be fine because they're awesome investors. That's just not an interesting discussion. Right? I actually think until you cut him off, Jason was starting down the far more interesting discussion. And it's super interesting with this group because I've actually never had this discussion with two people who've done the thing. There's very few people who've done the thing that Victor did, which is raise a solo fund. And the odd thing is I'm on a podcast with two of the people who've done it. Both of you, as brand names, right? So I actually think talking about is Benchmark awesome is fun because they are fucking awesome, but it's just not that interesting.
Would I do it if I was Victor? Yeah, of course I would. I would. And you know why? You know why I would? Because he showed in his investing that he likes to move across scale in a way that I don't think Benchmark likes or allows in their disciplined manner. In a similar way almost to Miles Grimshaw, who's another fantastic investor. But I think they are multi-stage investors and just want to intersect with founders, whether it's at the pre-seed, like Victor did with Brex, or whether it's writing a $55 million check into HeyGen, which is really outside of what a Benchmark deal would normally be, being that size check on entry. And I think I look at it and go, hey, I just want to engage with the best founders. I don't want the constraints of a partnership. I can get a lot of money privately from great individuals, and I'll own 100% of the carry. Frickin' men. Thank you very much. I'll do that all day.
I hear you. I just have a more nuanced view now that time has gone on, right? I remember when I left, I had two of the top brand name funds reach out to me that I did not know well. It wouldn't have worked out, right? But I had a pretty hot hand when I did. Harry will remember, right? And I didn't even take the meetings, right, for real, because I'm like, it's just not. It doesn't. I can't get the math to work in my head. The 100% of the carry, right? I can't get the lack of autonomy to work in my. And I'm like, I've been a founder with a modest level of success. I ain't gonna go work for somebody. Like it was I didn't take any of these meetings. Like, but time has gone on, and I do think that if you're gonna leave, understand the value of the brand you're leaving behind, right? It's more. If you have no brand, and here's my only point, and Harry challenged me. I just think in today's world, if you have no brand at all, it's tough. I think it's tough.
100%.
You disagree?
100%. You're so right. It's tough. But I do know Victor, and he is in the most exclusive inner circle of Silicon Valley that exists. He's in the Sarah Guo, Elad Gil, Pat
and so
Grady,
he has his own
royalty.
micro brand and of relationships that will make it work for him, right?
Unbelievable. And I would actually say the thing that's more important and attractive than brand is scale of cash. The only thing that I find attractive about joining another firm, which I never would do ever, obviously, but is the fact that I could deploy $1 billion check into a great company. And actually, I think scale of cash is almost a more attractive magnet than stellar
That's
brand.
the one way the world's changed, right? We wouldn't even be having this conversation even 4 years ago. Even 4 years ago, we wouldn't have the conversation, right?
Yeah. What you find I'm just thinking here, what you find attractive about being on your own, to your point, Howard, it's the ability to deploy large. I'm just trying to understand it. The ability to deploy large amounts of cash. What Jason is missing is making the point is, so you give up on the brand if the existing brand is strong. So you probably have to come to the table with an equivalent brand. And you probably do, because if you don't have an equivalent brand, you won't be able to get the big cash. So what you're basically saying is, and I agree, is that if I have, let's just say, a functionally equivalent brand as an individual to the brand of the firm I'm at. In other words, high, right? So I'm not losing a ton on deal flow from transitioning, and I get all the money myself, then I should just go do that, because I can do what I want untrammeled. Right?
100%.
What's interesting is the people who need to think about this a lot are the LPs. And I'll tell you why. Because what it says is, we will now finance you to do all the things that we spent 20 years telling every other venture firm not to do. Right? And I think that's a big insight. Right? For 20 years, if you think about the kind of, like, very much an LP focus on discipline, stick to your lane, do the stuff you do well. We value teams, we value cohesion, we value long term. And what they're now saying, and maybe correctly, this is not a diss, this is a reflection on where the world is and sometimes the value of listening to advice and sometimes the value of not listening to advice. What they're showing by their actions, and we'll talk about Elad in a second, is they also like a product that says, thank you for your input on being focused, I'm ignoring it. Your input on being a value add in terms of taking board seats. In Elad's case, I'm ignoring it. Thank you for your input on small fund size. I'm ignoring it. Or, by the way, after giving me all this input, I'm ignoring it all, and then you're going to give me the money. Note to self, what are you doing here, people? It's super interesting, right? What it says is, as I say, thank you for your advice. Now thank you for your money. And that's why I think it's an interesting time.
What does that tell you then? That Elad has such a strong brand that he is able to do that, say, thank you for your advice, I'm not going to take it, over and over again. And I don't mean that badly against him. He's incredible.
I think what it says is exactly that. I think it probably says two things, and they're nuanced because they go one way. One thing it says is, in the end, idiosyncratic success triumphs bland, mediocre, standard advice. Winners win. If you see something working, you're just going to lean into it, right? Because I think LPs correctly are saying, I had this pattern matching thing, and these are the things that I said we shouldn't do. And then I look at, moving on to Elad here, because we had him on to talk about next. Oh my God, this guy was a seed investor, Airbnb and Stripe. He's ridden the last 15 years. He's not put a foot wrong. He has access to the best deals. Screw my rules. This guy's going to make money. Right? So on the one hand, it says, capitalism works. And so part of what's going on is there's a big signal coming here that says the things that we believe for 20 years mightn't be as true today. We should lean into the new. That's the positive side. And I believe that, to be clear. I actually look back and I go, and I'm sure you'll ask about this when I say it in a second, so we'll put a pin in it, is that you look back and you go, there are things that I thought one had to do that you look back and go, maybe you don't. Right? But let's leave that for a second. The other side of the table is this. Sometimes rules of thumb or heuristics are in place because across cycles, they've been proven to be correct. And my guess is some part of this trend makes total sense. And some part of it, you'll look back after the next down and turn and say, oh yeah, that's why we had that rule. That's why we had the stick to the knitting rule. That's why we had the more than one partner rule. And I think you'll find some parts of this, like totally free and easy, will prove to be challenging as you move across an entire cycle. And zooming out, never forget, there's no data on anything through a cycle yet for anything that started from about 2010 on. Right? So again, I think the LPs, I think they're discarding some of their rules of thumb, and in some cases they'll be right. But my guess is there was an embedded piece of wisdom in that will come back when you discard it to bite you in the butt as you go through the next downturn. So that's a long answer, but it's frankly, I think it's a super interesting subject.
I think Elad is the best embodiment of the concentration of value. And to your point of, picking your space, you said very wisely, Rory, and I always remember this. Josh Kushner is a master property developer in the way that he picks the block and buys the best house on the block. Stripe in fintech, Databricks in data, OpenAI in AI. And I think Elad is very similar in terms of making sure that whatever that category leader is, whether it's Helsing or whether it's a bridge or whether it's Stripe, or whether it's Harvey, he is in that leader and he's in it big. I think that's really impressive with him. And then he's also an amazing picker. I remember he sent me Vanta at pre-seed. The man has access like no one else. He's able to cover spectrum like I've never seen before. Do you know what I worry about when I see this news? Speed of deployment equals relevance. And I think about this because we're very disciplined on 3-year fund cycles, temporal diversification. I know everything that we've said, maybe Jason doesn't agree with on temporal diversity, but just like doing what we said we'd do on how we invest and how slow we are. And I see actually cadence of deployment can lead to relevance in a way that really benefits that manager.
Yes, it does. And I think we talked about this before. You internalize that in the short term, that's true. And again, and the only guardrail on that is, the only people who mind money are the people in charge of minding the money. And the people who are in charge of the mining money here are the LPs. And they're trying to figure, on the one hand, they want, because people who are deploying capital quickly and getting capital are by definition getting short-term positive feedback. No one deploys $1 billion, values it at 800, and then gets more money, right? So if you're deploying capital quickly, you can assume you're getting markups, you're getting success, you're in the hot deals, right? And what, you're left with is the LPs trying to figure out, is this a hot hand that I have to follow? Or is this a flash in the pan signal and it could blow up in my face? And it's not one or the other. It's a tricky thing to figure out because, by following, you made a comment on consistency. By doing what you said you do, by being consistent, you lower the chance of just drifting off and screwing it up, but you probably pass up on the upside of being as aggressive as someone who's not honoring the temporal diversification and who is using that velocity, right? So all other things being equal, the person who's doing more deals has more relevance. So therefore, the only question, as long as they're deploying it well, it's a double win. You have relevance in the short term and returns in the long term. If you deploy it badly, you have relevance in the short term and failure in the long term. And, I've seen examples of both, right? I mean, I think Elad Gil is, for example, the example of the latter. I think wildly successful, seems to be doing everything right. I'm willing to stipulate one of the most talented investors of the generation and will do it really well, right? And continue on doing it well. That's one example. I've also seen the examples of people who've been relevant for 2 years because they're putting the money out and then the money blows up and they're gone. I mean, Tiger's the obvious example. Now they're still around, but a shadow of their former selves. Their quote unquote relevance in 2021 meant that they saw every deal that year, but they picked badly, so they got sent home. Same thing with SoftBank. You can be relevant. Put it this way. Any early stage VC worth a damn in Silicon Valley knows who the dumb late stage money is, right? And you can tell. I remember watching, I won't even name names. I was like, oh, that late stage investor is attending that early stage investor meeting. I know why they're there. That's money. That's dumb money that they need. So, and those investors obviously blow up. So in the end, relevance is a short-term thing. And in the end, like I say about this job, the only thing that's true about this job over the medium term is you have to be right. And the hot hand who's right across an extended period of time, and as I say, Elad, I think is one of the best of that, you deserve to get the capital. You deserve to get the runway because you've proven over 10 or 15 years your ability to pick. And as you say, stunningly, pick both early and late, right? I don't think... Yeah, we can come back to what is wrong with the single person model, but I'm willing to say the following. If it doesn't work out, it won't be because the person in charge of it isn't brilliant. He clearly is. It'll be because structurally there are problems with that model or that stage.
Well, the interesting thing is when you look at bluntly the best performing managers or the breakout managers of the last few years, I think you put probably Thrive, Green Oaks, Founders Fund and Elad Gil definitely up there. And all four of them are one person led. I'm not saying there's not great teams beneath them, but they are one person led very dominantly. That is interesting. And that's a very significant change from the venture partnership of old that was so predicated amongst the industry.
It is. And it's easier, I think, perhaps wrongly, to be one person led the later you go. And the reason I say that is this. If you are, let's just play it out. If you want to be an early stage investor, right, and you're putting up, doing Series A's, I'm going to say just doing early stage because I recognize that all the names you cited have some amazing early stage investments. And I want to come back to that because it's important, right? Because there was an insight in that the pure late stage guys didn't have. But if you want to put most of your money in early stage investments, right? What it means is every partner can only do so much. And if one partner is called the dominant partner, then all the others are, to some extent not able to speak for the firm. And you don't want to have a person doing a 10 or a 20% ownership position who can't speak for the firm, right? So I think in early stage, if all your dollars are going early stage, even as a partner in the firm, I want the guy in the next who's running 10 more deals beside me to be roughly a peer of mine, because I don't want some weak person who's not that good, who's frankly a bit of a beta, who's willing to work for half nothing to be running my money. Right? Because which is why Benchmark as the quintessential early stage firm internalized, you need to have, you need to have equality so that anyone can be a premier partner. It's totally different late stage. When you're not trying to be on the board, you're not trying to be involved day to day, your time is not consumed by the deal. You're just making decisions, right? Making decisions arguably can be best done as a smaller group. So in the limit, you can have, one person making the calls on late stage deals, and it's much more scalable. Because remember, if you're trying to put out $1 billion and you want to write in $20 million checks, someone has to make 50 decisions. But if you put it out in $100 million checks, someone only has to make 10. And it's hard to make 50 decisions. So I think what you see about these, as you say, mainly late stage funds, is that someone is capable of making the big decision. They have structure to do other things, but then someone is calling the big shots, and they've been getting it right. And that's true for Greeno. It's clearly true for founders, and probably even be true my guess is fast forward 3 years, there'll be 3 other people in the firm in junior roles, but that guy will be calling the shots, and he's earned the right to.
Rory, can I be so blunt? Does it make you question your model when you see these kind of dictatorial-led firms, not in a horrible way, but dictatorial-led firms with mass capital sources, and then you look at yours more discipline-led sized and with partnership structure?
No, I think no, because I think we're all children of the era we grew up in. And, we survived 2 downturns. And typically in the downturn, the high-priced late-stage guys go bust, right? So, and I'm not saying all these guys will, but it's what happens in every time. Because remember, you're only taking one risk as a late-stage investor, which is valuation risk. And when it goes wrong in 100% correlated fashion. Everything blows up in your face. So,
my liquidation preference always bails me out, doesn't it, Rory?
Yeah, and by the way, and just for our listeners, you're being sarcastic there. You're exactly right. It doesn't. So I think to build over an extended period of time, I think you have to be much earlier. And that's been our primary focus. And I think to do that, you have to have much more of a partnership structure. So I think that's the place you end up in, right? If you wanted to build a late stage firm, you can be much more hierarchical. By definition, almost you should be, because there's a whole bunch of economic reasons we can talk about that. That's a fun thing to do. And look, cynical comment, not cynical, realistic comment. I said this to our place, if I'd known in 2009 that we were heading into the best equity decade ever with 0 recessions, coming out of the worst equity decade in a long time with 2 recessions, I might have played a different hand. Right? If you know that stocks are going to go up pretty unstoppable. We're at an all-time high today. They've gone up for 15 years. If you knew that, the correct risk-adjusted, work-adjusted, money-adjusted play was to just do Tiger and not quite shank it in 2021. I don't know if that answers your question. If you knew then what you knew now, you might make that play and make more money, but you design to survive the cycles you've seen.
Well, we can move on, but I actually would go that Tiger will do better than people think, given their positions in OpenAI, Scale, there's many others that actually are not bad companies. And you said there they picked wrongly. I would argue they didn't pick wrongly; they just picked everything. And in that, there's some good and some bad.
I totally agree. And it's not oh my God, look, they're stunningly successful investors. It's just, as an LP, you probably would prefer to have skipped that experience, because one of the things you have to look at is, you'll have this phenomenon of the average IRR is great, but if most of the funds went in at the top, the LPs who just participated in that, not so happy. I agree. It's not that they're not going to make money. I'm sure they have many mentions, but it's not investment excellence as you'd want to live it.
I think, listen, I know you want to move. I think maybe it's a discussion for another time. To me, the interesting thing about Tiger, they played the game on the field, right? Like many are doing today. They played the game on the field. What they did, though, at least in my limited direct experience, is they played it broader than most, right? So today, Harry, we're all talking about piloting it. What should we do? Should we do Anthropic at 100, right? Tiger rode the vibe of 2021, which I don't even think is barely worth talking about. It's such a strange world where every B2B company was a winner that was triple, double, or better. And so what I think Tiger did and SoftBank, but really Tiger and B2B, is they lowered the bar because everyone won. The average public SaaS company in 2021 was growing 70% public. Yeah. So now we're doing something different, and that I think that was the bet on the field, right? But it's going to Harry's point. It's going to turn out in the end, only a fraction of those investments are going to have the power law benefits, right? Which we all think is so obvious today. but they were just playing a different game, weren't they? Yeah, everything worked in 2021, right? Today, we're kind of like, some things work and a lot of other things are getting funded, but we're not agreeing everything works, are we? In the age of AI, we're not agreeing on that.
Pretty clear on that. Everything does not work. But I'm just going to commit one other point because it was important and I put a pin on it. I think the names you cited, those excellent investors, the green oaks that thrive, one thing that's super interesting about those firms versus, I'm going to call it the quintessential late stage only firms, is these guys also have done some amazing early stage investments. I mean, by definition, Peter Thiel at Foundation did the best early stage investment ever, Facebook for 500K. So it's not that the interesting insight is it's not that they're, quote, not early stage investors. Their real brilliance was realizing that being a great early stage investor with an implicit $200-300 million fund size allowed you to have a $3 billion fund size where the median, the pooled dollar return is on your late stage investments because you're deploying lots of capital at late, but the entree to that has been your brilliance at early stage investing. And that's why those guys are different. And in my view, better late stage, how'd you put this? Better, more likely survivors than the late stage players who dash in from the public, think it's all a financial game and then get blown up, right? These guys, the list you named have, in my view, played it perfectly. And including jumping Elad in that. Having really great early stage deal flow and access, and then realizing that the best way to monetize that is to follow on your $10 million A check with a $200 million Series E check and collect the money every way.
We'll move on, but the brilliance of Josh and Neil from Thrive and Green Oaks, they made $500 million plus from Carvana in the public markets, buying when it was in the dumps and riding that up. That is a fucking good picker when the world tells you otherwise. I mean, such credit.
It was tough to look at that stock chart and make that bet. It was a falling knife, that one, right?
And then Neil also does windsurf at Seed.
Yes, agreed.
I give up, Neil. Too good. Anyway, we said about concentration of value. Anthropic started out raising at 100. Then it got so much demand. It went up. It landed somewhere between 150 and 180. I heard it was closer to the 180, which wouldn't be surprising. I'd love to hear your thoughts on how you guys read this, what you make of it.
Well, look, the interesting thing here is I believe that there was $1 billion late last year and $4 billion this year. So this is classic, the thing of what really counts as the first derivative, the growth rate, maybe even the second derivative. Not just the growth is good, but the growth rate appears to have accelerated, which is stunning, right? In other words, because most of your expectation is you start off growing at 300%, then 200%, then 100%. So the absolute numbers are going up, but the growth rate's down. These guys appear to have re-accelerated at scale. So you're doing $1 billion, you're, doubling, more than doubling, and suddenly you're doing $4 billion and you're 4 or 5xing. So if these numbers are correct, that's amazing. And I think that's what's getting valued. And we can both feel smart last week because you pinged us on OpenAI versus Anthropic. OpenAI at 300, Anthropic at 100. Feeling pretty good about that 1.8x in a week. If only we bought. So yeah, I think that's what it is. I think it's just people are looking at the reacceleration, and it's clearly a 2-horse race, brutally. And with everyone else either not shipping or not monetizing, and are not relevant in the case of some of the smaller things. And you're buying the reaccelerating winner.
I'll tell you for what it's worth. You also asked about capping Claude Code, right? For overage. I know this is one part of Anthropic, but my experience in vibe coding, my captain obvious learning is we're vastly underestimating the revenue potential per developer, per user of Claude and Anthropic. We're vastly underestimating it.
Why, Jason? Just educate me.
Because what was clear to me, I was on a path to spend $8,000 a month vibe coding, okay? And even with that, Harry, what's happening now the context windows have gotten longer. So now on Replit, and I think Lovable just did in the new release, you can have up to a 15-minute long context window while it's thinking through debugging or complex stuff, okay? You know what I would love to do now? Run 4 of them at the same time, or maybe even 15, okay? So that 8K bill, all things being equal, could easily be 10K. And I remember, and I didn't get it, maybe a month or two ago, Farhan, one of the CTOs at CTO at Shopify, let all their developers use the most AI they wanted, no caps. And the top guys were using 10K a month on credits because they were running multiple things in parallel. Okay. And if we're talking about 15-minute context windows and this, whatever, ChatGPT 5 has a million tokens or a billion token windows, right? Debug my entire code base. Now do this other thing. And now I'm doing 10 things in action. I think my learning is I think every developer at a top tech company growing is going to give them $10,000 a month of AI credits. Everyone's going to get 10,000, not 200, which is what we're thinking. We thought that was a lot a couple months ago. They're all going to get $10,000 a month. Every leading tech company. It's cheaper than hiring any human, and you can't find humans. So if that means a 50x growth per developer spend, it's going to be a CFO's nightmare. But putting that aside, that's 50x growth from where we are today for Claude Code and Anthropic. Or if they use it through Cursor, it really doesn't matter where you're buying the tokens. 50x per human. That's a lot of growth, isn't it? I'm convinced it's like blinding the obvious to me now. And Shopify already got there. Like 10K is fine. Not 200, 10K. And we're going to consume... and the other thing that the CEO of Replit said, I think yesterday about this was you can't cap it because any great developer will consume almost unlimited tokens no matter how cheap they are. So I think we're all going to land at this 10K, 8 to 10K per month. If you're a good developer, you're going to be on 24 hours a day. You're going to be on AI, not a couple minutes here or there.
First of all, directionally, I totally agree with what you're saying, which is zooming on a million miles. I think what you're saying is, these guys, and bringing it back to Anthropic, these guys have a model that makes developers who are expensive assets extraordinarily productive. Somehow the market's going to find a way to massively reward them. I agree. And you made a comment on capping, and it's been interesting. Separately, Anthropic did some capping for their plans, and I think Cursor did some capping and some token limiting for their plans. And you'd asked the question, Harry, is that good or bad? I think it's amazingly good, right? I think what it says is as Jason said, there's infinite demand for this product. Right now, at the price point of $200 and the cost of generating those tokens, the economics doesn't work for the model provider. And, you could look at that and go, oh my God, I'm going to worry about the fact that is the economic model wrong. And at a point in time, it probably is. My guess is somebody's gross margins are troubling. But when you're selling something, we have a couple of facts. One is, the long-term trends are in your favor because all these costs just go down over time. Thank you very much, Mr. NVIDIA. And you've got almost infinite demand. You just price it to the point where you just get these people hooked. And over time, your costs are going to go down and their hookedness, as Jason said, is going to go up. And maybe today you're selling them $200 worth of tokens. So you're getting $200 and maybe you are spending $250 in tokens. So you cap them now at 170 and you think your margins are crap. But next year, that 170 will be 120, even if the token count goes up. And as Jason says, you raise that 200 to 400. What it says is there's not infinite, but an astonishingly strong demand pull for Claude Code and related products, either directly using it via Claude Code or indirectly using the Anthropic models with one of the other providers like Cursor. And that's going to reflect in the Anthropic numbers, which is reflecting in the valuation, and it's going to reflect in a whole bunch of pushing and shoving around gross margins for a year. But in the end, you'll stabilize out to something that works for everybody. So I think, it's astonishingly bullish on market size and growth.
Moore's law shows the reduction in cost over time has pretty much always been an immutable law. When you look at that immutable law and the impact that will have on token cost, surely that impacts what we said there about per spend per developer being 10K per month, because in 3 years' time, it'll just be so much cheaper on a per token basis.
Yeah, but the products, the whole reason your lovable investment works, Harry, is these products are so much better than 6 months ago.
Thank you, Jason.
Maybe, but and you're right. Maybe it all plateaus. I think a lot of that's shooting from the hip. I just think these products are getting exponentially better constantly, and we'll consume a million tokens and a billion and a trillion. I mean, or the token value will be more. We have inexhaustible demand to run multiple processes in parallel 24 hours a day for development. Like our agents don't sleep, Harry. This is the thing I didn't get until I ran like 4 different AIs for SaaStr. Our AI SDR brings in, we were DMing yesterday, right? Our AI SDR brought in a deal, like a 70K deal, and it doesn't sleep. And if you're an engineer or developer, your AI isn't going to sleep anymore. Now, you don't want it touching production code. Okay. I have learned that lesson. Okay. But if it's debugging or or working on complex issues or building out an algorithm or doing refactoring part of your code base, you can consume, it can work for you 24 hours a day, right? So, and we will use all of the there may be an end limit, right? And so maybe this investment will peter out, but I don't see it today, right? I think, good God, we're all going to be coding 24/7 with our agents. Everyone's saying that like it's so hard to get a job in software today. If you look at the Wall Street Journal, it's not remotely true. If you have the skill set today, if you're super smart in math or CS or physics, and you're in any school today, like my son's a freshman and he's off the charts in math. He already has offers, okay, and he's not even looking, okay. So we have this, this is what we know, but I can see it in the real world. If you're a top tier developer, like you just want to arm them up with every tool you possibly can, because no one wants the folks that went to DeVry programming school like they wanted in 2021. That market is dead, right? So we're going to arm them up with $10K a month.
Listening to everything that you say then, Jason, Anthropic is at least a $2 trillion company.
Maybe, right? I mean, it's just, there's just so much investment here, right? Now, are there issues obviously OpenAI is coming very hard at them right now, right?
I'm not signed up for 2 trillion, but I am, and I don't have to be to say that, this is going to be an extraordinarily valuable company. I don't, there's only 4 or 5 companies that are worth more than $1 trillion. And it's worth pointing out that only one of them is, really selling just kind of NVIDIA, obviously, which is pretty much a monopoly, selling, 100% market share in the most valuable commodity you have. All the others touch every human being on the planet who has IT. Apple, Google, Facebook, and Microsoft. So I don't think for the record, just to say it, I don't think you get to it more than $1 trillion if you're just selling stuff to developers and infant, which isn't to say I don't think you do extraordinarily well.
If Anthropic ends the year at what, 7 billion in revenue, right? Velocity. And let's say the average Anthropic developer customer is paying $100 a month now, and that goes to 5,000. Okay.
Yeah. If you multiply,
now that's 50. So what's 50?
Jason,
what's 50
if you multiply
times
by
8?
50, everything's amazing. I agree.
But I'm not being facetious. This is my Captain Obvious epiphany that this is bigger than the $4 a month we spend on Jira at Atlassian. This is all the VCs like to talk about how AI is going to tap into the human budget, and some of it is just Sony baloney. I've learned this is completely true for developers. $10,000 is nothing to replace a $500,000 fully burdened developer that quits in 7 months, Rory. These kids are quitting. Okay, they're quitting for the $100 million off. I'm not being facetious when I think it's 50x. I'm not being facetious, right? It may not add up to 2 trillion, but I think the TTAM, the true TAM, is 50x what it is today, without question, because this is the greatest case, not of making developers just more efficient, right? But of truly tapping into that non-existent human budget that people have. Right? There's no one to build this software out there, Rory. There's no one to build it. There's outside of Cursor, no one can hire anybody. And even at Cursor, it's hard to hire, isn't it, Harry?
It is. They have a big war chest, and so
even at Lovable, it's hard to hire, right? Now, Lovable doesn't win every developer they want on planet Earth, do they?
Listen, you mentioned Lovable. We mentioned Replit. We saw Microsoft. We saw Google roll out Lovable/Replit competitors. Question being there, is it too late? These are actually very established brands in Replit and Lovable in this case. Is it too late, or is incumbent distribution so overwhelmingly strong that they will be the victors with these?
It's a funny one. The Microsoft competitor to Lovable and Replit, right, and Bolt. Now this will change. It's beta, right? It's limited. Everyone shares one database. So you may have seen some issues I had around my database, but at least I had my own one. Everyone shares the same database. So Microsoft has a clear warning: be careful what you put in the database. Maybe you don't want to build what's the app that just had the terrible leaks today that we were just talking about before we started? Yeah, don't build the T because everyone's sharing the same database. What that says to me is, look, listen, Microsoft can catch up. That's not taking this seriously enough. Or it's being so panicked that you have to put something out there, right? Which is probably more the case. They're so panicked that it is a big deal, right? That Replit and Lovable are 200 million in 6 months, that we'll put something out there that no one in their right mind would use.
Yeah. I agree. I mean,
one database. They only bought one. They could only afford one instance at Microsoft. They only could afford one database at a time.
they could only code one at a time. But yes, I mean, so the answer to the direct, is it too late? In other words, are the lovables already too established for Microsoft to matter? I actually think Jason's is the right answer. It's more a question of, are they going to focus on this thoroughly and comprehensively enough to win? Because if they put all their eggs in winning this basket, right, they probably could. But, you know, it seems odd, for example, to angst as Microsoft about, oh my God, I'm losing $100 million revenue to Lovable, when wake up, I'm losing $900 million to Cursor in a product I already have been shipping for 5 freaking years in GitHub Copilot. In other words, if the thing you delivered first can't beat the newcomer, how are you going to beat the even more trivial newcomer where you're later than them? Right? So I think, you know, brutally, I think,
Rory, is GitHub just a massive fuck up for Microsoft?
No,
if you're sitting in that meeting, you're going, oh my God, we had the start, we had the runway, and we've let someone come up from behind and seemingly trounce us. Is that the mindset, you think?
I mean, they probably would say, oh, we have $500 million of revenue we're doing. They'd probably have some corporate story why they're better. But the truth is, yeah, it's a mistake, because whenever you start, I mean, the thing about in any market when you're Microsoft, if you start with a monopoly and you fast forward 3 years and someone exists, by definition, you screwed up. Your job as a monopoly was don't lose the monopoly, right? They had massive market share with GitHub. And, you know, they added the Copilot, you know, when Nat was CEO, it was it was an excellent product. And, you know, fast forward 4 or 5 years, they seem to have slipped up. I mean, you can't not say it's a mistake. I mean, because you shouldn't let that happen. So yes, it is a mistake. And that's my point. If you're chasing shiny object symptom on the next thing, which is now I have to do a lovable thing, are you really putting enough effort into making sure that your Cursor competitor is as good as it should be? And, you know, I think and this is kind of, and I'm not fully formed on this yet, so I'm kind of going out on a limb. For all the Microsoft is amazing in AI story, they're better than AWS of the 3 hyperscalers. But, you know, they don't have their own model. The relationship with OpenAI is a bit tortured. Cursor's now 900 million, and their developers, which is their core kind of raison d'etre in a world where they're at 500 with a 5-year start. I don't think they're playing a perfect game. And I don't know if trying to do still more things is the way to win here versus actually doing some things well. And
that's the trap, right? Trying to do even more things usually doesn't work, no matter who you are, right? Startup or Microsoft, it doesn't usually work.
And, you know, Satya made the ever so funny comment that, you know, he wanted to make Google dance. Well, you know, fast forward a year or two, they appear to be dancing pretty fucking well.
Microsoft own OpenAI in many respects. Amazon own Anthropic in many respects. And then Google own distribution and Gemini in a way that is very, very powerful and important. You have to buy one and you have to short one. Which one do you do?
Which of the 3 stocks are you talking about? Buy Google, short AWS, Amazon. They're just, I mean, and I'm not fully developed on that yet. I haven't spent time thinking, but Google has the advantage of underestimation, right? It could lose its search business. That knows it. You know, there's a lot in this. Because remember, I was just talking about the hyperscalers. If you looked at the 3 hyperscaler execution, then it's easy. Let's just do the hyperscaler first, because otherwise we don't have to think about retail and search, which are big things, I admit. On the 3 hyperscalers, 5 years ago, Amazon built the category and was the dominant one. Microsoft was number 2 because they could lever everyone into the Azure, so they were kind of limping onto the field with a bunch of relationships. And Google was nowhere to the point where there were credible stories about them getting out of cloud. Fast forward to this quarter, Google's nailed it. Great growth in Q2. As of the recording, we don't know where Amazon and Microsoft is, but funnily enough, by the time you produce this podcast, people will know because I think they're reporting tomorrow. But my gut is, just looking at the trends, that Google is pulling ahead and is the smallest, but by far the fastest growing. Microsoft is roughly equal in scale to AWS, admitting that there's always some weird accounting of Azure, and has a slightly better growth rate. So by definition, of the 3, AWS is the hyperscaler underperformer. And I'm 100% certain I could make that case. That was a lot.
Listen, I don't,
great.
obviously if I had to make the bet today, I would make Rory's, but I won't make it for the captain obvious reason that one of the reasons is there's unlimited demand and it has its own TPU, right? As Amazon licks its wounds and recovers from, which it's already working code red on, right? When it gets back in the sweet spot of what its customers need, demand will be unlimited.
Agreed. I think you're right, Jason, which is
You look at Oracle.
Then agree. Oracle, I mean, if you have, I mean, and I look at this a lot because there's a little part of the contrarian in me that says, could you hit the point where that stops? Because if it does stop, the correction's going to be super interesting, right? So I look at it and then I have to, and I'm kind of trying to be the cynic and I'm trying to find some evidence of overshooting on demand. And to your point, Jason, you're exactly right. I can find none. You kind of go, I can't remember, was it Amazon or I think Microsoft said, biggest problem, didn't have capacity. I think one of the other hyperscalers said, we could sell more shit if we had more shit to sell, right? That is, and you're right, Jason, that is the best thing in the world. The simplest thing in the world is to be selling something that everyone wants to buy. And it's just a beautiful place to be in right now. And all those guys are there, right?
Yeah. And the Wall Street Journal had an article yesterday of what the number one KPI for public company CEOs is. It's reducing headcount and growing revenue. Reducing headcount. That's the number one. From Bank of America on down, it went through all these big, not just the little tech startups. Everyone wants less headcount. And the answer, Meta, is AI. There's unlimited demand to do that, to drive headcount down and revenue up. So I guess it's going to end, but when we're all just living in the matrix.
I don't think it ends that way, to be. I'm just going to go out another limb. I don't know. I've had 2 coffees today. I don't think it ends when, everyone's automated and the demand stops. I think what really, and I'm keeping an eye on this because there's a trade to be done when it happens. I think what's interesting is the creation of AI kind of is happening at hyperpace. There's, $600 billion of CapEx, whatever, just a huge amount going on. Enterprise's ability to digest it is still relatively slow. Even though demand is growing, you're still at the 10,
super early.
25. And I think one of the weird things would be how long can you continue investing $600 billion a year against a $30 billion growing revenue line? I mean, at some point, like for example, even Microsoft, it was interesting. They did a bunch of layoffs and, Satya did his comment on the enigma of growth. I didn't quite get, I think what he's saying is really, he's trying to say, yeah, it's pretty cold-blooded to fire a bunch of people when you have hyper growth and 40% operating margins. But what he didn't say is part of the dirty little secret is we're going to have to start depreciating, half our free cash flow and CapEx through the income statement over the next 3 years. So we're going to have to take people out just to be the same level of efficiency. So there's a lot going on. At some point, someone's going to depreciate all these NVIDIA chips and someone's going to have to pay for them, right? So I do think there might be a slowdown at some point in time, but right now there's no evidence of it whatsoever. And, everyone did oh my God, NVIDIA's in trouble at 140 and now it's at 170. The only trend worth a damn in the last year has been lean into the hypergrowth. Lead it and limit the math.
Just so I understand, Rory, you're saying depreciation is the primary reason why you'd see that dampening.
No, I'm saying not just depreciation. No one ever gets. No, I'm saying if you continue to spend and run through your income statement, large CapEx without an associated revenue line, eventually the world says, dude, maybe you shouldn't be doing this. Right. And the truth is right now, you're getting the depreciation. You're not getting the revenue commensurate with the spend. You're getting revenue growth. Jason is right. There is large corporate demand, but even with the best will in the world, they can only digest so much software in a year. Right. I mean, yeah.
David Kahn from Sequoia's.
And I love that piece. And honestly, I thought about writing something like it. And I was like, oh, it's done now. Don't need to say that. But the interesting thing is, it's a great quote. The market can stay euphoric longer than you can stay solvent. If you traded that position a year and a half ago, you'd have said demand's going to top out. You'd have shorted NVIDIA at 100 and you'd be one sad puppy at 170. And forget even the stock prices. The spend by the CapEx, the hyperscalers has gone up since then. So I think the thesis is actually correct at some point, but that's, excuse my language, fucking useless if you're a stock trader. Is it correct today is the only question worth a damn. And I don't know when that happens.
And I think when you bring that back to Jason's point of the $10,000 per developer, Jesus fuck, I just want to buy more and more and more NVIDIA today.
And I go, fully priced for that, baby. So I'm not in the same place, but as yet, I go back to, but I think Jason is right. Fundamentally, that insatiable demand is there. The only question is how quickly can it be met quick enough to cover the nut?
Can I ask you, do you think, and I sound like a communist here, but we have never seen incumbents at this size and scale before with this dominance, where they can drop $15 billion on a team and it's 40 days of free cash flow. Bluntly, who gives a shit about the money? It's worth the chips on the table. And when you look at Google's asset base, it's insane. Yeah. Are these companies too powerful?
No, I'm just going to go straight out to the no, because whenever people have been equivocal on that, one of my big ahas, whenever people have been equivocal on these kind of questions, you end up with people coming up with dumbass things like the whole AI regulation, like the whole FTC process. So there are some things about these powerful corporations I don't quite like, right? And I wish we could do nuance and fix some of the problems without going crazy. But if you have to pick one of two worlds, either idiot regulation or just let free capitalism run wild, I'm voting for the latter, because I think in the end, Mr. Market will take care of these things.
I don't know, dude. Mr. Market says that, Adam Smith's invisible hand, and you're seeing that now with Zuck hiring with an unlimited budget, making B2B hiring, to Jason's point, the biggest problem in startups. That will just get worse.
The interesting thing is we have to decide if oligopolies are okay.
Yeah.
Now, monopolies, the case is clearer, right? And maybe monopolies are good. Monostopies are even more complicated. But we could argue the monopoly dynamic. Here, all of these that we're talking about, the reason they're interesting is they're oligopolies. We have 3 to 4 players, right? We have Oracle's all of a sudden competitive, right? Massively competitive with Google, with Microsoft, with Amazon. We have OpenAI, Anthropic, Grok, and friends. And so if you want, I think if you want to give up on oligopolies, I quit this venture. I quit this business. Let me return capital. I'm going to do an open view. I'm calling it a day. Here's the rest of the money. I'm going to write out my winners, because if oligopolies aren't okay, I quit. If you read a classic textbooks on oligopolies, they compete on features, not price. There's a lot of hints of that, right? That these products kind of are the same price, right? Today. And a lot of folks believe that's good for an economy, is because oligopolies maximize innovation. They don't maximize discounts, but they pour all the money back into R&D because they're competing on features, not price, right? If you believe in technology, you might almost want oligopolies, right? 3 to 4 players.
I totally agree with Jason. I just want to come back to your point on too powerful, because I think they're two actually slightly different comments. All the incumbent older companies, the trillion-dollar companies, are in their own market monopolies. Apple, I would argue, near Microsoft, Facebook, Google, in an old market. Search, iPhone, social, though they'll resist that definition forever, and whatever Microsoft is, corporate, right? So in the old businesses, they're in their monopolies. But Jason's exactly right. In these new businesses, where they're putting their money and where the new startups are coming in, what you're seeing is oligopolies, which is what you'd expect. Now, maybe fast forward 10 years and they grind down to monopolies. But right now, in the markets that matter, for all the power that Apple, Facebook, Microsoft, and Google brought to the table, it's OpenAI and Anthropic that are making the run in. So I would argue that says there's simply no need for these whining, worrying FTC people to sweat it, because the truth is, none of those companies executed well. I mean, ironically, Google, whom we all piss on, right, and say that's good, has executed the best of the 4. They have a model that works. Apple doesn't even have a product that works. Microsoft bought someone else's product, but then doesn't quite own it, so it's kind of weird. Who else is there? Facebook is desperately trying to buy product, but it's not out of success. It's out of terrible psychological need for a product, even though they don't have a business to justify it. So I don't think these guys are too powerful. If anything, I think they're a bunch of rich people on the back foot behind the new trend, desperately trying to catch up.
Rory, what do you do if you're Apple? You're looking at that assessment, which I completely agree with.
I think as a board, you say to yourself, do you have a management team that's too old? Because that's the only button you have. And I love to, I have made a lot. Apple is my largest single position. I have agonized about selling it for a decade and a half, and I haven't. So I love that, man. Thank you very much, my little house. Much gratitude. But you just do wonder, is this the team to grab what's going on in AI, which they absolutely should have a product on? And at some point, do you say you just have a bunch of folks who aren't figuring it out? And do you make a change? And that, that was the comment. Rather than some kind of tactical, hey, you should buy X, Y, or Z, look in the mirror and say, are you getting this done? Now, I think it's very hard for a board to do. I think it's very hard for a board full of supernumeraries to do. It's very hard when the numbers are still good, but you haven't grown in 5 years. You've done a magnificent financial engineering. Thank you very much again for your dividend, but you're not winning. And at some point, the buck stops at the top.
Well, do you think AI, I don't know. Do you guys think AI is a legitimate threat on its own to the App Store?
No.
Because if I look at Apple today, it's 25% of the revenue is from the App Store, 40% of its profit, right?
Yes.
And 75% of its revenue is iPhone and App Store. So if AI just enables more apps to be purchased and Apple keeps its tax, right? And AI maybe you should stick to your lane in the short term, right? If you couldn't get Siri to work after 27 years, if App Store is a monopoly, to your earlier point, and it's not everything's under threat from AI, right? Not everything. If it's a beneficiary of AI, right, then maybe they have the last laugh. Maybe they have this high margin last laugh of all this AI revenue gets more and more of it gets routed through App Store, and they take their 26%.
Fair comment.
Could be worse. Could be worse than taking 26%.
By the way, I agree with that, Jason, because you're right. When you make the hardware and the logistics of making the hardware the thing you're amazing at and hopefully the design, your whole business doesn't go away. You're exactly right. You don't have, you can talk about Google, ironically, and say existential threat to the downside if no search. No matter what stuff we're using for AI, I think we'll be using on our iPhone. So I think that's a very fair pushback. It's not as existential, right? But, the brutal thing about capitalism, it's like, what have you done for me lately? Congratulations on building the best consumer product in the last 50 years. Thank you for the App Store business and the services business, which is fucking awesome. But did I mention, what's the new thing, right? Do you want to run the risk of another, waving my arm furiously here, OpenAI type personal companion that knows everything about you? Do you want to let anything get between this and you as a user for your 1 billion user base? So I agree. It's not existential. It's not like, but if you're not moving forward, it's the shark thing. If you're not moving forward, you're dying, and they're not moving forward in AI. Google pays them to be the search provider, and maybe they just collect their tax that way. You're exactly right. Then that OpenAI can do the same thing. And maybe Apple says, we build great hardware. Our hardware has such a dominant place that people will continue just to pay us money. So we got it from Google and we're fine, even though the courts are trying to stop that. Now we're just going to get it from OpenAI. You're right. That's the argument that says, stick in your lane. You make the 20 billion from other people giving you money. I don't know if I buy it, but yeah, that's the argument.
I don't know how much OpenAI pays Apple today. Let's assume it's still zero, right? Yeah. Which it used to be. I'm skeptical. But, if it's, Jesus Christ, 108 million going through per month. I may have my number wrong. Even if there's a sweetheart deal here, if Apple can just keep 25% of all of that, it's a good model.
One of the challenges I would push therefore is owning the hardware is a great bit, and it has a long inertia factor. In other words, long after you stop innovating, you can keep monetizing, right? Which is, I think, the stage where they're at now. And the question is, at some point, do you need to do more than that to keep not just surviving but growing, right? And and maybe it is stay in your lane and just get paid by everyone else effectively for placement.
I love that debate, by the way. That was a fantastic discussion. For me as an observer, it was brilliant. But
it's a tough one.
You said there about management team switch maybe. Zuck hired again with another stellar hire from OpenAI, chief scientist or whatever it was. He is going all out. To what extent are we like 80% of the way there in his mind, do you think, in terms of his acquisition on talent spend versus this is 5% of the way there? Like, when does Zuck stop this siege?
I don't have a clue. He seems to, I mean, his argument, which when you heard him speak, is if I'm spending $30 billion on CapEx a year or 40 billion, whatever it is now, do I need to, should I skimp on the 5 or 10 people who can spend that most correctly? It's Jason's point. The super S-tier engineer is spending so much money that, you know, you don't care. My assumption is that at some point, the marginal return on the next scientist gets negative, so you probably stop spending $100 million a pop. But, you know, I get what he's done. He said, I'm going to spend $50 billion in CapEx. I better spend $1 billion, $2 billion, $5 billion to make sure I have the smart people to kind of implement that program. It makes sense.
You know, it's not even that big of a deal because if he wants, which isn't going to happen, he can always just stop. It's only in the past. He can stop tomorrow and say, we're just gonna harvest classic Facebook ad revenue. We're gonna become the next Yahoo, and we're gonna kind of just be a cash cow. It doesn't matter what, like, if you're a public company that's massively profitable, the past doesn't matter, does it? It doesn't matter, right? You can write off anything. You can fire all the people, and you're still obligated with these massive contracts. But you can also write them off as one-time expenses or stick them in another bucket. They don't matter. If you have massive cash, you can always do a mulligan at least every 8 quarters.
Yes, and obviously they did a mulligan on virtual reality with the whole.
Yeah, the mulligan.
But the argument is, well, again, he gets to the, are you buying insurance or is it existential? I mean, implicit in that statement is that if you do nothing, if you're unsuccessful in AI, your core business just continues to compound, right? And as long as that's true, you're right, Jason. If the core business is kicking off, $200 billion a year of revenue, 40% of, if your core business is kicking off $40 or $50 billion and you make a $40 or $50 billion mistake, you just go in the penalty box for a year and you move on. You're exactly right.
Yeah.
But of course, part of the reason he says he's doing it is because he says it's existential. The horrible outcome is you misfire on the new innovation and the new innovation eats your core business, right? Like I would argue for Google, if they misfired on AI, they wouldn't have search. Whereas I think your point was more right than me. If Apple misfires on an OpenAI type AI product, they'll still be making hardware and it won't be existential. And to your point, if Facebook misfires on Meta, they clearly still have Facebook. And if they misfire again on AI, as long as they still have, $40 billion of free cash flow, nobody cares. So you're right.
And I think the other thing is like when I intentionally, Zuck is telegraphing to the market, I'm making this bet, like very clearly, right? And so like when I was a VP at Adobe, you're trapped with your 40% net margins because you can't invest in anything because the market is expecting cash to rain to the bottom line come. And yes, Shantanu did a good job when they were moving to the cloud of getting some credit once for a massive generational shift. But Zuck can not only spend all this money, but he can say to the market, give me a little bit. And Larry's doing the same, right? At Oracle, give me a little time, right? We're going to get back to those classic margins and the market won't punish you because most public companies are trapped in their margins that are profitable. You're stuck. Like you can't go back. It is almost impossible for most public companies to actually spend the cash they're generating. So Zuck's got a triple down here because he's getting also a hall pass. The market's saying it's okay to spend everything, right?
Look, remember, it's not only that the market won't punish you. The more important point is the market can't punish you because you have, in the case of Meta, you have voting control. So, yes, the stock.
Yeah, your stock price could be punished.
But it's worth pointing out that's why I think you're exactly right, Jason. If you're a quote normal company, your stock price goes down and the vultures circle. Whereas if you're Meta, your stock price goes down and you're sad and you say sorry and your employees don't do as well and there's dissatisfaction, but you still have control. Same thing with Oracle. So I think that you're right. Those two players can swing a bat, secure in the knowledge that no one has a voice other than them, which must be nuts.
And they can actually spend their cash, which is otherwise trapped.
Yes.
It's trapped with these large public companies. It just builds up in weird areas and it's unspendable. All you can do is repurchase your stock. Right? All you can do is buy something, an acquisition, and do some accounting shenanigans, right? Or repurchase your stock. Most like steady state, boring public tech companies are trapped when they're profitable. It's great because you're not losing money, but the lay people are like, why don't you invest it? It's not that simple. your EPS goes down. No one likes that with a normal company, right? No one likes that with a normal, mature. No one wants to see Zoom's revenue EPS go down. Like, it's the whole value of the company today, isn't it?
And this is why Mr. Buffett is right. Once a company becomes X growth, the most important thing to assess about management is their ability to rationally allocate capital, including sending that capital back to the shareholders, which is, as we said before, Oracle has done in spades. Anyway, what else, Harry? What else we got?
Final one, and then we'll do a quick fire. It's just Figma's obviously going to IPO this week. I do think we have to talk about this. I don't think enough people are excited enough about it. I remember when this would have been the most exciting thing in tech this week, and it would have dominated news. This is, it looks like it'll price at, 18.8. I think it prices, 5 p.m. Either today or tomorrow, which is yesterday when this is out. Are we excited enough about this? How do you expect this to pan out? Is a pot baked in? Help us understand it as an audience.
I think it's unfolding. If anyone listened last week and this week, by definition, they're a glutton for punishment. But it's unfolding exactly what we said last week, which was the filing range was, I think, 24 to 28 or something like that. They've drummed up demand, which felt low. They've drummed up demand. Just in the last 24 hours, they've refiled to, I want to say, 32 to 35. So it's worked. The bankers are doing a great job. They've whipped up enthusiasm. Now that they know they're multiply oversubscribed, they've raised the filing range. I'm sure the rest of the drama is pricing at the high end or maybe above the range, and then a pop. So the whole movie's unfolding exactly, mission executed. There's been a lot of talk about how they're trying to make people be more specific about their demand to better allocate the shares and avoid that pop. But I think the structure of these approaches means that that's almost unstoppable. So my gut is, and this is horrible because you're predicting something, you're breaking the first rule of predictions. You either predict a number or a time, but never both. And I'm predicting something now that by the time this thing comes out, people will know if we're idiots or not. But my sense is it's hard not to imagine this thing pricing and then popping very well, because the structure of how they went at it is such that they will almost certainly be that money left on the table feeling. But I'm wildly excited about it. I think it's great. I mean, it's a wonderful company. It's got compelling numbers. It's a great story of a guy picking himself up after a difficult acquisition and showing the world it wasn't just going to be, a acquisition or nothing story. So, and by the way, I think everyone gets excited once it prints, because it's all just talk now, but the reality of 4 VC firms each making $1 billion, that'll focus the mind.
It's funny. I just remember September 2022, SaaStr Annual was in September then, and the Adobe deal acquisition happened, and 10,000 people talked about nothing but Figma.
Correct.
Nothing. Now, this was after it was a fascinating deal because the 2021 bubble had crashed, right? And all of a sudden, Scott Belsky and team are our heroes. They're going out in 2022 and paying 2021 prices for this scrappy startup Figma, and it was people's jaw dropped, right? It's like, this was the deal of the century, right? Fast forward to today, and this is in my ecosystem, people aren't talking about it. Listen, 4 VCs making $1 billion, great topic for the pod, right? Don't get me wrong, but it's just boring to people today. And it was the 10,000 people, executives. The crowd was hushed in 2022, September 2022. No one nothing to talk about. And now let's I might burn 6,000 on my Claude credits this month.
World, yeah.
Lovable did what again? I mean, it's not that this, hopefully this is a $30 billion market cap company for all of our sakes, but it's the zeitgeist has been lost here in traditional software. Even the best of the best of the best. Figma is S tier. But it's not capturing our imagination the way it was. And maybe that's okay. B2B software used to be boring. Maybe it's super boring again.
First of all, I just want to cue the Scotty Schlafer, the interview, the 5-minute interview, when he says, you win the Masters, and then, 5 minutes later, it's like, the press is asking me, how are you going to play next week? This feels like that. It's like, venture returns $30 billion, and all Jason's got to say is, well, what's going on in Lovable, right? There is, but I think you're right. I mean, this
it's the vibe. We're all vibers now.
A couple of things. One, there's no doubt that, once you announce a $20 billion acquisition, everyone's kind of mentally ran the cash register, so you don't get the, it's odd to take the victory lap twice, but I totally think they deserve it. But I think the more salient fact is what you're saying is There's still going to be a few more pre-AI IPOs at scale because there's a couple other companies like that, like Canva and SaaS. But you're right. The hype cycle has moved on to the news story on what's going on in AI, which, by the way, doesn't mean that massive amount of money can't be made in other areas, right? I mean, I always think, and even in, I think if you look back, semiconductors became uninvestable by venture in about 2004. And in the subsequent 20 years in the public markets, people made out like bandits. It was the best performing sector ever, even excluding NVIDIA, right? So I think what's happening is startup activity in the space that Figma plays is not going to be a thing anymore. You're not going to do you're not going to build a non-AI collaborative design tool. You're not going to build a non-AI any kind of B2B software. So as you say, Jason, the excitement, the new thing is not that, but that's a function, by the way, of it taking 12 years to go from a startup to an IPO. By the time you get to an IPO, and I think we're going to see this across the board, by the time companies that are 10-year-old get to an IPO, you probably are half a tech cycle or a tech cycle behind. It's terrifying. But and what I said this to an LP, our holding period is now longer than the tech cycle. That's a terrifying fact. Figma's holding period is 12 or 13 years, and you're now in a world where they talk in the S1 about, we're going to have to adapt to AI. Now, it's going to be an amazing company. It's going to be great. And I think they will adapt to AI, but it's just we're talking here about intangible things, not money things. And I usually prefer to talk about money things. But you're right, Jason. From a buzz perspective, the caravan's moved on. But on the other hand, it's moved on and deposited $20 to $30 billion. I think everyone involved will get over their sadness very, very quickly when they look at the stock charts.
And when Figma nails vibe coding, man, that's going to be what we all want.
What?
Well, they're going after it with Figma Make.
I know, but it's what we really want. We don't really want, because if you look at the replets and the lovables, like today, and the world's going to change, and I'm a super fan of both, right? Notwithstanding my bumps. But a huge use case today is prototyping, if we're being realistic. It's prototyping apps, and it's very powerful and it's very fun. And the pixel perfectosity is terrible. Like the apps look, you can smell these apps and they're not what real apps look like. So as soon as I go into Figma and do this, and it looks like I really want it to look like a designer, I'm out. I'm out of anything that's not pixel perfect. I just don't want it. Like I don't want, it's just like a Squarespace site. I don't really want something that looks like Squarespace. And I can smell a lovable or Replit app within 6 seconds of hitting their website. And so Figma isn't going to disrupt programmers, right? Like the way Lovable and Replit is. But this prototyping, I don't really want to do it in these apps. Listen, you're closer to it, Harry, than I am, but I can't imagine this isn't a very interesting war in 2026.
You mean, to be clear, the war between the vibe coding and, design tools like Figma? Interesting.
Right now, they're great. You can go into Bolt or Lovable and Replit in different ways. And in some cases, in one click, go from Figma back and forth. It's great. But today, they're great partners. It doesn't make sense that they will be great partners for prototyping in 12 months. It makes no sense. And Canva saw this early, right? I don't know whether they'll really get there, but they saw it. That's why they tried to go really early into this. They got it, right?
I think Canva's product will much more compete with Lovable's, being the much more consumer friendly, children doing science project, mothers doing businesses. That is I think the designer to really average consumer bluntly is a very different product paradigm to design for. And I don't see that competing.
Makes sense that Canva is a bigger competitor at the low end, right? And that's why Wixbot, Base 44, whatever. But but I see on my social, got to be careful of X, right? It's a weird cross section of the world. But notwithstanding all the complaints, a lot of developers are using these products to prototype. The folks that have helped me as a vibe coder, these are CTOs. I had a CTO reach out to me at 80 million. He's like, I just didn't want to distract my team. I'm building my own app in Replit. Here are my 10 tips. And so that I would rather do that in Figma, that use case. So it just, the competition is at multiple levels, right?
Yeah, because some part of the Figma user base is, more picture perfect, full on built out apps, but some is rough me up what this thing would look like. And your point is you might want to do that now using a tool that actually builds you a vaguely functioning prototype.
Well, even more like, listen, I mad respect for Figma, but as an end consumer, I hate it when I get a Figma link because the thing doesn't work.
Yeah.
I don't want to click through from like this is why working with designers I want to blow my brains out. I don't want static stuff. Okay, I want it to, like when you send me my Figma. Okay, I want it to. Now I'm not expecting that it works in production.
Yeah, I
right? I want it to work. I don't want design elements. And so as soon as my Figma works out of the box, it's vibe coded. Man, that's all I want. Right.
And then the fun thing for those guys, I mean, look, the very best companies run by founders who see this, who've demonstrated, and in my view, these guys clearly have the ability to bounce back from stuff, are going to be all over this shit. And you're right, 12 months from now, it's going to be, you know, if you don't have $1 billion at stake in it, it's going to be fun to watch, you know, what kind of products these guys roll out to be competitive with parts of either the coding, the cursor, or the prototyping marketplace, and how that design all the way through the code marketplace shapes out. Because look, there's a big pot of money here and everyone's trying to make sure they get that bit, right?
We're going to have some fun here, okay? So we're going to do a Kalshi quickfire, but I'm just going free rogue on this one. And I tweeted this last night because I was just super freaking intrigued to see where everyone landed. And so the tweet was, let's play a game. End of next year, over, under.
Under, but close. Yeah.
Well, you think, Harry, help me multitask. We're coming up on $1 billion today, right?
Yeah.
And the bet is $4 billion next year, right? What is just my L4M model say? Just trailing velocity say? That gets me to almost $3 billion or so.
Yes, you get to 3 billion. Yeah. So
okay, now use my math of at least spending twice as much per developer, bare minimum, right?
Yeah, you get there. You're right.
I got to go. Yes. On this one.
Yeah. You can get there. You're exactly right. I buy that. By the way, it does, and that, by the way, is also proof. If they're doing 4 billion, and I don't believe the gross margins are as negative as people say, but if the gross margins are 50%, that's another 2 billion coming on Tropic's way. So it's been good for them too. Next.
Yeah, I don't think the gross margins are negative.
I agree. So even 50% gross margin.
I can tell you, as someone who keeps paying these Replit checks, they ain't negative. I guarantee you, Replit's gross margins are pretty good. Okay, they're pretty. I bet they're in the 60s even today. I could be wrong, but they're not losing money. They're not, at least at the gross margin level. There's no way they're losing money with what they pay, what they charge. Right? It's a high markup to give you this environment. Right? It's a high markup on those tokens.
Lovable hits 400 million ARR by the end of next year.
End of next year?
Mm-hmm.
First, I have no doubts.
Yeah.
That's easier to do the math. 1 to 100 in 6 months? I mean, that would be a colossal F up if it doesn't get to 400. As crazy as it is, right?
Where does it price then, Jason?
What's that?
Where does it price?
Unfortunately, Harry, it might be to a down round to the recent price. Unfortunately,
he's just messing with you.
Cut. Jason,
there's only one hitch in the analysis. It's just as we regress to the real world, right? As we regress to the mean for valuations. Unfortunately,
It's interesting. When I look at those two bets, they're not dissimilar in the sense of Lovable being at 400 million versus Cursor being at 4 billion, right? I'm just trying to assess the relative likelihood of the two. I think the Cursor bet's a little more sure. The trajectory of Lovable, as you know better than me, 100% points to that. The only thing that could bite you in the butt would be some kind of churn explosion. And you obviously have the data and I obviously don't. So I'm just trying to come up with, hey, it's your job as an investor to think, what could prevent that from happening?
Yeah, the bull case is easy to pull out of our rear. The bull case is easy. We could do that.
The bear case is you were wrong about long-term duration of subscription. And, you would argue, Jason, that's not the case because you're now a guaranteed Vibe Coder subscriber.
Final one. We've chatted a lot about predictions. The final mother of predictions, OpenAI. Is it over or under on 800?
What do you mean 800 for what?
800 billion valuation for a company.
When?
By the end of next year.
Oh.
Now, it's, reportedly raising now at between 360 and 380. Just
under. I'll tell you what I'm doing mentally. It is no logic. I'm just looking at the step ups in the rounds, as you'd expect, are getting smaller. right? You get 2 or 5x, and then you go from 80 to 150, which is almost a double, just under 300 to now 350. I don't know if they raised at 300 and there's now 350 going on. I'm just guessing. Do you see another doubling round by the end of next year? It's a lot to have happen, right? It might be worth it, but another priced round above 800, don't know.
I'll take the contrarian on you there and say that because of GPT-5 and because of Codex being two very significant breakthroughs, they'll have enough, plus Johnny Ive coming out with something, a first product. The three combined will be enough to get enough excitement over 800.
Just two quick thoughts on it. One, I think there is so much money and more invested in this company. Sometimes these valuations are just willed. Sometimes the people are too deep. Everyone's too deep into OpenAI. And if OpenAI needs 800 to survive, OpenAI will find 800. It will find it. It may be through investors that get other things. It may be through existing investors. It may be through weird combinations of offshore money. But no one can afford for it to lose anymore. There's so many stakeholders that if that is what needs to be solved, 800, it will be solved. And I actually think the meta issue, the CEO of Anthropic had this thing this week where he was explaining, because they're supposed to be the good guys, right? We left OpenAI to build something safer. And he was explaining why we have to take money from the Middle East now. I don't know if you saw this, right? He's like, we have no choice. Yeah. His point, I guess the flip side is he didn't want to, that this was lowering their pristine ethical values to take money from the Middle East. But his point was we have no choice, right? So I think the bigger issue isn't 800 billion because people are invested. The bigger issue is, when will all the capital on Earth and Mars be exhausted? And that is a finite number, right? It is a finite number. Trump has already been lassoed into Stargate with David Sachs. I mean, Rory can help me figure this out. There is, at some point, OpenAI could consume all available capital available to it in the Western world and the Eastern world. Right?
Let's talk about a more nuanced version of that, because it's actually an interesting question, and I think Paul Kudrowski did a piece, right, which is just looking at the CapEx investment in AI as a percentage of GDP and comparing it to two other booms, right? The dot-com boom and the railway boom in the 1840s. I loved it because, again, I was trying to think through what are the comparables, and the railway track analogy is a good one. So we're running now at about 1.2% of GDP, which is basically 1.2% of GDP is going into making CapEx data centers, which is a little above the 1.1% of GDP that was going into bandwidth at the top of the 99-2000. So we're already slightly bigger than the bandwidth boom, and we know how that ended. But interestingly, and I did not know this, it was 6% of GDP in the railroad era a year. So at peak railroad mania, it went to 6%. Now, as they pointed out, in that case, you were building an asset that lasted 150 years. And in fact, just today did a huge acquisition. Whereas in this case, you're building an asset that depreciates over 3 years. So it's not like with like, but just to kind of give a sense of the outer bounds, to your point, Jason, of how crazy could this get, right? We're already a bigger boom in terms of CapEx than 99-2000, but we're nowhere near as big as boom as the railway boom. The pleasing thing about that answer is it allows both parties to continue to feel great. If you're a nervous guy like I sometimes am, you're like, shit, this is crazier than 99-2000. Makes me nervous. The internet was big. Don't know. If you're an optimist, you're like, hey, we're only spending 1/4 of what we spend to build the railroads, and intelligence is better than railroads, surely, so we're fine. So it's a nice piece of analysis that literally doesn't allow you to conclude anything, right? My gut is, all joking aside, that I don't think you can get to 6% of GDP.
Apollo was 4.4%.
But that's
the
not
space program. Just the space program.
Yes, that's the total. Well, now I'm winging it, but I'm totally willing to do it. That's 4.4% of GDP across 8 or 9 years, which is an annual spend of about 3.4%. It's not a single year. There's no way we spend 4% on Apollo. I think, we were only spending 6% on defense. So no, it's per year.
If I believe Reddit, which is always correct, but it breached 4.5% in 1969 and was just under it in 1968. 4.4% of our whole economy. And in all seriousness, I think that's why Sam Altman named it Stargate. I think everything he says that seems simplistic and calm and almost cute when he says Stargate, he's like saying, listen, guys, we spent 4.41% for several years on Apollo. We should spend more on AI. I don't think it's a coincidence. I don't think it took me a little while. I don't think anything he says is flippant. I don't think it's flippant. I don't think it's off the cuff. And I think he's doing his own nerdy style of clear communication. Stargate is Apollo. We need it all. And David Sachs is making it happen.
Right. So so 6% on railroads ended in a bust. 4% on, I'm going to give you your 4% for 2 years, and I'm going to check it all. But let's say you're right. It is worth pointing out in 1970, they just stopped funding NASA like crazy because they're like,
the crash. If you look at this chart on Reddit, the crash is bad, man.
Yeah.
Actually peaked in 1965.
Yeah, what's our lack of America? Plank take, we've got the moon, we're done. Let's kind of recycle the dollars here. So, 4%, then it crashes. So you could look at 1.2% in bandwidth, then it crashes. So we're clearly above the possible crash limit, but below the outer bounds. I don't know what to make of that, right? I don't know if you spend as much per year for 5 or 6 years on this as you do on railroads. We'll see. And this is why, going back to what I said earlier, you can love the long-term trends, but at the same time, you can say to yourself, at some point, there could be a break in the spend. To bring it back to your point, it's also why you have to go to sovereign wealth funds. Because you need, we're now so irrelevant in the context of financing this that it's almost laughable, right?
I think I'm going to get in trouble for this. Laughable, that's a moral debate on, oh no, I'm sorry, we have to go to Saudi for money. No shit you do.
Because that's where the money is. I also think it's fair to them, and I'm trying to don my they obviously from day one, Anthropic was set up very much thought to be more angsty than most about, trying to do good. And it's interesting, if you look at both companies, if you just read OpenAI and Anthropic, it's been a long journey from we only want to do good to, oh my God, we need to raise a lot of money. And it's almost touching, and it's starting off with innocence and then coming to grips with the fact that it turns out it's very hard to raise $200 billion for charity. Whereas $200 billion to turn into $800 billion, you can find pretty much anyone to do it. It's basically watching a whole bunch of folks realize that there's a reason why capitalism exists. It's actually life affirming. As a capitalist, you can go, these are people who a priori would have been appalled by all this, but when they went out to actually pursue their dreams and they wanted the capital to get those dreams possible, they had to join the system. Yeah. Welcome to capitalism.
And that, to tie it back, and that's why I think if OpenAI needs to raise at 800, not wants to, if it needs to, it will solve for it. Whether it's sovereign wealth money, whatever, marked up stuff, warrants we don't see, backdoor promises for access.
That's actually an interesting point.
It'll solve for it.
That last one will be we didn't talk about it. We didn't have time, but you're right, Jason. Part of the asset you have to monetize is your ability to tell, large sovereign wealth. You can tell it. I think OpenAI is already telling it a domestic sovereignty story. Will give you your model, will give you your thing, and people aren't going to put an ARR multiple on that. They're going to, for the right.
They don't care. So
I think you're right. I'm not sure it'll be worth 800, but again, one of the reasons I like doing this is I change my mind when I hear good arguments. You're right, Jason. If they probably could find a way to back into it, which is different than saying it'll price the day it goes public in a public market, which will be a very different discussion.
Tim, I've got to be honest, I think the best show we've done. For me as a spectator, I've enjoyed it the most. The debates have been fantastic. Bravo, both of you. Really, amazing fun. Thank you for this, guys.